I think the one thing we also have to think about is why rates might not be coming down, right? Because I think it's interesting you're seeing this, Michael, you brought up a good point, a knee-jerk reaction. I think that's exactly what you're seeing today because the bond markets have been pricing this in. I think we all knew that the Fed was going to have to either start pausing here or cutting less than they were expected to. But if they're not cutting because the economy is strong and prices are still stable, that's very different than them having to cut one or two more times next year because they need to save the economy. And if you're in that position where the economy can continue to grow, unemployment stays low at these higher rates, I don't think that's a problem for a lot of the equity markets in general. You're seeing this knee-jerk reaction specifically on some of your rate-sensitive sectors. So things like real estate, things like small cap are clearly playing off today. But inflation is going to be a concern next year. So you want to have those inflation hedges in there because that could be a problem, but you want to make sure you balance that out.
So in that scenario that you laid out, Courtney, does that mean that these dips in some of these high-flying names, I mean, do you go in and buy big cap technology? I mean, I think that's what, I don't want to boil it down so simply, but I'm sure a lot of people at home are thinking, you know what, NASDAQ down 3%, 3.5%. Is this my chance to get into an NVIDIA? Is this my chance to get into Bitcoin?
I think what you have to look at, too, is even though this has had a dip, these are still doing so well since the beginning of the year. So when we look at our clients, most people are still way overexposed to these. We've been trying to get people to take some profits off the table. Even with this dip, that's still the case. So is it buying opportunity? Probably. But most people, I would say, are still overexposed to it. So I think that's something you need to balance out.
Without being a little bit cliche in sort of the tale of two markets next year, I mean, you could easily see a scenario where you go into next year, profit growth is reasonably strong. You know, this rise in rates ends up and the sell-off in stocks gets washed out because of the strong growth environment, all the promise of, the fiscal policy that might be coming under Trump, et cetera, only to see earnings growth start to slow as you get later into the second quarter, into third quarter, and at the same time, restrictive policy, right, start to bite a little bit. And in that way, to Dan's point, it is very reminiscent of 2022. Just rather than runaway inflation, you have higher than average inflation. Instead of, an earnings recession, you have slower earnings growth. Instead of a Fed that's hiking, you have a Fed that's pausing, all coming off of elevated equity levels and tight spread levels. That does not bode well, I think, for back half of 2025. But near term, I think the signaling is actually reasonably strong.
I think the pullback in banks is actually really interesting. I don't think that the environment for banks, the backdrop for banks, which I view as very positive. Yeah. Right? I think you've got growth in loans because I do think the animal spirits are still there. I think you've got great potential for M&A, good capital markets, and they're not crazy expensive. And so this pullback, I think, is attractive. I would be adding.
Yeah, I just add one other thing, and I know we don't price in geopolitical risk, but if I look around the world, I cannot remember the last time there's been so much uncertainty. Look at what's going on in Canada right near us. Look at what's going on in Germany. Look at what's going on in France. Look at what's going on in Russia and Ukraine. Look at what's going on in Syria and the Middle East. Look at what's going on in China and Taiwan. And that's not just the only point I want to make here. China's economy is a disaster. Okay, when you think about this, we have disinflation here, and they're worried about a reflation, right, of that. But look at what's going on there. They might be they might export deflation to all the points, around the world that is not helpful to us one way or another. And if you think about this dollar, it's going to continue to go higher under that scenario. So I just think this is a really messy year. And then you think about what we learned about President-elect Trump's first admin, there's just going to be so much rhetoric that moves around. CEOs don't like that sort of uncertainty, especially when things are going great here, fine. If we have to worry about tariffs and then we have to worry about weakness all around the world and a strong dollar, that just doesn't set up for a great scenario that gets you to 15% year-over-year earnings growth, in my opinion.